Another successful day, global trade champions. Let's continue growing together. 2 weeks ago, I uploaded a video on payment terms in international trade. Today, I've re-recorded it with enhanced visuals and additional content, and I'm excited to re-upload it. You'll find a link in the description and comments where you can download the presentation in PDF format. I recommend watching the video first and then reviewing the PDF for a deeper understanding. It's a great way to solidify your knowledge. We come together to discuss a vital aspect of international business, payment terms in foreign trade. Now, I know that when we think about global trade, we often imagine bustling ports, vast cargo ships, and goods flowing across borders. But, behind the scenes, there is something even more fundamental that keeps this complex system moving: how we manage our financial transactions. In the world of international trade, the way payments are handled can make or break a deal. It determines trust, reliability, and the very essence of our business relationships. We need to understand the risks involved, not just from the perspective of the seller or the buyer, but for both parties. Because it is only when both sides feel secure that trade can flourish. So today, we will look into the various methods: cash in advance, letters of credit, documents against payment, open accounts, and more. Each has its own risks, its own benefits, and its own story to tell. We'll explore how businesses can navigate these waters with confidence and security. Let's get started and dive into the intricate world of payment terms in international trade. Okay. In international business, settling financial obligations for goods or services is a critical component. In this presentation, we will discuss various payment methods, the risks involved, and strategies to mitigate these risks. In international trade, payment terms specify when and how payment for goods or services will be made. Common payment terms include cash in advance, CIA, letters of credit, LC, documents against payment, DP, documents against acceptance, DA, open account, trade credit, and consignment. These payment terms are listed in order of increasing risk to the seller, exporter, from lowest to highest. This means that as you move down the list as the numbering, the seller's risk increases, while the buyer's, importer's, transaction risk decreases. Each term presents a unique set of risks and benefits, which we will explore in detail today. Cash in advance is a payment term where the buyer pays the full amount before shipment. This method provides guaranteed payment and eliminates the risk of non-payment for the exporter. However, it offers less flexibility for the buyer, as they must pay up front. While it ensures low risk for the seller, it may discourage buyers due to the high risk of non-delivery. A letter of credit is a widely used payment method in international trade. It is a financial document issued by a bank on behalf of the buyer, guaranteeing payment to the seller upon meeting specific conditions. This method provides security to both parties. The buyer's bank issues the letter, the seller ships the goods and presents the required documents, and the payment is made once the documents are verified. The letter of credit procedure shown on the right side of the screen illustrates the practical steps involved in an LC transaction and the role of banks in facilitating it. Please pause the video and review the sequence of transactions for a better understanding. The LC mitigates risks by ensuring that the seller receives payment if the goods are shipped and the required documents are presented. It is generally more advantageous for the seller, or exporter, because the bank guarantees payment as long as the seller provides the correct documentation, shipping documents, regardless of the suitability, quality, or quantity of the goods actually shipped. When negotiating payment terms for a letter of credit with your business partner, you will consider the following types of letters of credit, depending on the specific circumstances. Irrevocable LC is the most common type used in international trade, for the stability of the transaction. On the other hand, revocable LC is an exceptional type. And LC at sight is a type of letter of credit where payment is made immediately, or at sight, upon the presentation and verification of the required documents. This means that as soon as the seller, beneficiary, submits the correct documents to the bank checks them for compliance, and if everything is in order, the bank makes the payment right away. Often used in commodities trading and other industries where quick payment is standard practice. While USAN's LC allows for payment to be made at a future date after the presentation of the required documents, it provides the buyer with a grace period, credit period, typically 30, 60, 90, or 180 days, after the shipment date or the date of presenting documents before payment is due, unlike LC at sight. In addition to the types of letters of credit introduced here, there are various other types of letters of credit, such as revolving letter of credit, standby letter of credit, transferable letter of credit, and back-to-back letter of credit. Therefore, when discussing payment terms related to letters of credit with your business partner, if you come across unfamiliar terms, be sure to check the concept, risks, and advantages in advance. Documents against payment, or DP, is a method where the seller retains control over the goods until the buyer pays. Payment is made upon receipt of the shipping documents, adding a layer of security for the seller. Banks act as intermediaries, facilitating the payment and exchange of documents, which helps build trust and ensure compliance. Unlike LC, the bank facilitates payment to the seller based on the buyer's acceptance of the shipping documents. This means there is a risk that payment for the goods will not be made if the buyer refuses to pay by not accepting the documents. Under documents against acceptance, the buyer receives the goods upon accepting a time draft, promising future payment. This method relies on the buyer's promise to pay, offering less security than DP. If the buyer defaults, the seller faces the risk of non-payment. An open account is a trust-based payment method where the seller ships goods and invoices the buyer for future payment. While this fosters strong long-term relationships and encourages repeat business, it exposes the seller to significant credit risk. Using trade credit insurance or conducting regular credit assessments of buyers can help mitigate the risks. Meanwhile, trade credit insurance, TCI, also known as accounts receivable insurance or credit insurance, is a financial tool that protects businesses against the risk of non-payment by customers. Trade credit insurance will be explored in more detail in the other video. Consignment is a unique payment method where the seller ships goods to a buyer or distributor, consignee, but payment is only made after the goods are sold. This allows buyer to offload inventory without upfront costs. However, it also carries risks, such as unsold inventory, non-payment, and legal issues regarding ownership. This page provides a brief overview of recent trends in electronic payment systems. A recent representative example of digital currency and blockchain technology being used for international trade settlement is JP Morgan's Onyx and its use of JPM coin. JP Morgan Chase, one of the largest banks in the world, launched its own digital currency called JPM coin in 2019, which is based on blockchain technology. This digital currency is used primarily for facilitating instant payments and settlements between institutional clients. Different payment terms present varying levels of risk for both exporters and importers. Exporters may face non-payment risks, while importers risk receiving non-conforming goods. Factors such as the creditworthiness of the buyer, nature of goods, and political stability influence these risks. It is crucial to assess these factors and use risk mitigation tools accordingly. Exporters endeavor to mitigate risks by conducting thorough due diligence, performing credit assessments, and utilizing trade finance instruments such as letters of credit. Meanwhile, importers aim to secure favorable payment terms and leverage trade insurance to safeguard their interests. Understanding and effectively managing payment terms in international trade is critical to the success of global business operations. By choosing the right payment terms and employing appropriate risk management strategies, companies can safeguard their interests and ensure smooth transactions. Thank you for your attention, and I look forward to discussing the topic of risk management tools further in next video.